you tips of the week about how to grow your startup is that the bar is always low when it's about favorite VCs, because not many people have favorite VCs. So, but all the same, I am here. And today I left behind my virtual background. This is our real background. This is over in Expert Dojo. These are all of the companies that we have invested in, which is many, many, many companies. And what we wanted to do at the beginning was, rather than have logos of the companies, which I know a lot of folks do, we know that companies are just people, right? And we know that for the people, everything is just about how people feel in a particular moment. And so all of these founders that we've invested into, we have this really nice Andy Warhol type feel to what they're like, but also we also got a statement from them, like about where they are. So some people are like, oh, entrepreneurship is the future. That guy over there in the green, Alex, he said, nobody knows anything. So it depends on where you are with your path. And there are cautionary tales with everything. Number one, if it is entrepreneurship is going to change the world, nothing will stop me. Well, you find that like that positioning at the beginning will tend to evolve as you go through. And if you get to a place of nobody knows anything, that is because you have spoken to so many people who have given you so much advice, of which much of it has not been perfect. And that makes sense, right? Like I always find that like advice for founders and learning as founders is a little bit like advice as parents. You know, people can give you advice about how to take care of your kids, but how much of that advice has actually been useful for you taking care of your own kids? Very little, right? Because all kids are different, all ages are different. Your reaction to how your kid deals with a certain thing is very different from somebody else's reaction, etc., etc., etc. So I have two big messages that I want to bring up for you today. The first is, the quicker and harder you go, and the more your eyes are open as to the reactions, that whole equal and opposite reaction to every single thing that you do, the more that you will learn, as long as your eyes are open to how those reactions are coming back at you. You have to take all of this and use this as your stack learning so that you continue to improve going forward. If you don't, then you'll end up with the same quote on the same wall for 3 or 4 years, and you'll end up hitting your head off the same wall, because you got to evolve with the things you're learning. My second lesson is what I always try and take to you from a personal perspective over at Expert Dojo, because even though we have invested, or we have invested in over 300 companies over the past couple of years, I still consider us to be a startup. I always will consider us to be a startup, because we're learning, we're evolving, we're trying to get better. We're trying to understand the startup landscape better. We're trying to understand how our growth skills can help the startups that we're bringing through. And we're trying to evolve and getting better. That's why we're doing things like building the celebrity fund, because we know that celebrities will give more juice to the growth in startups, which will allow startups to grow more. But that is not my message for this week. And my message for this week is something that I kept hearing one of our startups say. And for me, I was like, in this context, I don't necessarily agree, but in most other contexts, I do agree. And that is the term show up. So last week, I got a phone call from my man over in Miami, Stephen, and he's like, you need to be here on Saturday. You need to meet with these people. You need to come to this event. It's going to be incredible. And I was like, arms crossed, Stephen, I can't do that. I have so many emails to do. I have so much stuff to catch up on. I will get majorly stressed if I don't do my catch up. And Stephen said to me, dude, you got to show up. Like, you are no use to anyone behind your computer. And I really ruminated on that message, and it was very impactful for me. So I got a flight at midnight or 11 o'clock or midnight on Friday evening. A flight arrived in Miami on Saturday morning at 6 a.m. or 7 a.m. I then did meeting first thing in the morning, great meeting. Then met with the head of the Chamber of Commerce, great meeting. Then met with my man Stephen over there, great meeting as we worked through everything we needed to do. Then met with another 7 to 10 people who will be hugely impactful in his fund coming over. And then stayed up until 4 o'clock in the morning and got a flight back to LA and arrived in LA at 8:30. So I don't recommend that particular brutality to anyone. But what I do say is you gotta show up. For those of you who are behind your computer most of the day, trying to deal with all of the creative things, remember you are pre-seed seed. That means 30, 40, 50, 60% of your day, you have to be showing up. Today, we're going to dig into AI in a really big way. It's going to be a really exciting call. And I'm going to bring on like a phenomenal guest. And Irina and I are going to like dig into how do you grow? How do you build? How do you use AI to do that? But all of those things notwithstanding, you are the founder of your company. You got to show up every single day, finding new customers, wowing and wondering new customers, then making sure that you retain those customers, then making sure that you're building a structure so those customers can evolve to be the very best that they can be. So without further ado, let me bring in Irina, and then we're going to talk about valuable stuff.
Sure. Hi, everyone. Thank you for having me. Good morning.
Hey, how you doing?
Pretty good. Pretty good. Yeah.
And you're showing up.
And I'm showing up. And actually, to your point, I was looking at my schedule and I have so many events in the next couple of weeks. I feel like as LA is finally reopening, and part of me is, it's a lot, but to your point, that's when the conversations are happening. And that's, those are the best connections.
And I've been doing this for a fair old while now. And I always remember when I first got into startup on the venture side of it. And I would just meet so many founders who would spend their entire time fundraising. Like that's all they would do. And that's not what I mean, people, by showing up. That's actually called begging, right? That's exactly the same as what folks outside on the street, outside Starbucks, are looking for when they're looking for a cup of coffee. And it's okay to be investment proficient, but that is not what showing up means. That's a baseline expectation to make sure that as you're showing up for your customer, then you're amplifying that out to investors in the space, and the investors in the space are like, damn, are you kidding me? You're growing, you're showing up, your customers love you, you're retaining them. Please, can I invest in you? That's how this should be, right?
Yes. Yeah. Yeah. And I would say, go to build the relationships, right? I mean, I don't know if I'm sure this has probably happened to you. I mean, this was, I was a judge at an event last year. And so you could tell who was a judge, who was a startup, 8 a.m. I'm at a table with other judges, having coffee, and somebody just comes up and not even hi and just starts pitching. And and I'm just, okay, I'm barely awake right now.
Mhm.
And only to me, ignoring the two other people at the table, or actually it was a standing table, but still it was, a really interesting interaction, especially this is the first interaction we have with the startup. And so, again, left a lasting impression, but not the impression you probably want to make.
Yeah. And it's not showing up. And that's so interesting because it actually exudes desperation. And I think somehow, and it's, I'm sure it's our fault, but like somehow people got confused that everybody suddenly thinks of this numbers game where it's like, okay, here's my job. I got a startup. I have a company. I'm going to build it. It's going to be great. And so now I need to pitch to 30 investors a day or 20 investors a day, and then I'll hit my daily quota. And if I do that, and like what people are forgetting is that the real relationship is with the customer, but you also have to build a relationship with your partners. And your partners are your investors, your partners are your teammates, your partners are the KOLs, the influencers that you bring. Your partners are like everybody who has to invest time or money into your selfish endeavor, right? And the more risk that's involved in that, the more you have to be cognizant of that risk. And so I think it's a really good thing. So we're going to talk about all this stuff today, and we'll probably like draw a line on the turning up, because that's the thing I've just seen less and less of people doing. And the more the pandemic has gone on, the more people have kind of outsourced turning up to things that they've then really struggled with. And now people are in this really weird stage where they don't know what to do. And I think also the fact that I went to Miami last week and I saw everybody turning up, everywhere. It's like there's something in the air over there right now, and it's hard to describe. And that, yeah, so I think it'll be a super topic. But first of all, would you mind sharing a little bit about yourself to the folks on the call here? And people we have joining, by the way, we have investors who join us because they know that we bring in startups every couple of weeks, and we really dig into how they grew at the level they grew to. So we just take our high performing startups who are not looking really for money, but they'll share that. And then other startups who want to be able to take something really good on a Monday morning and go, boom, let's go out there and do great things.
Yeah, no, that sounds great. No, thank you for having me. So I right now help VCs and accelerators cut through the AI hype. As you can imagine, there's a lot of hype out there. Help a lot with diligence, especially technical diligence on a lot of these things, and happy to dig into it. I've been on the other side, kind of developed all of those things. I've led global data teams. I've invented algorithms, implemented them. I've taught many graduate students how to do the same. I've mentored, now I almost feel like I mentor, if not 50 to 100 startups a year, and mentored a lot of different accelerators. And I will say, actually, what stands out maybe from the startups that I meet from Expert Dojo is there's a handful that start with, hey, we're a few quarters away from profitability. And to me, I think that's so unique from all of the startups that I meet. And maybe we can dig into why that is. And I think a lot of your actually Monday events are about that.
They are, and we're still learning. And you know, even at the beginning of the call, how I said, look, I consider us to be a startup on many levels, because like a startup is really trying to get to that stage of building a product that customers love. And to get to that point, you almost have to go through the frustration of almost love to getting to like the incredible feeling of having real love, because you got to find out the things you're doing wrong. Nobody enters a relationship perfectly. That's why I say that piece where those startups that are looking for that perfect interaction with their customers, they hit profitability. And I actually met this guy in this Romanian chap over in Miami, and he had just exited couple of $100 million exit. And he said, yeah, we just did Duolingo from Romania, and we were really good at growth. And, you know, I borrowed $1,000 from my mom so that I could get a laptop. And then with that laptop, we brought in 2 or 3 friends who could code. And then we tried to find the things in Duolingo that just didn't work as well. And then we started layering in those features. And then we got really close to our like 1 or 2 customers to find out what could get better. And then it was like 3, 4 customers and 5, 6. So it's that intersection of how do you build that beautiful product? I think also to what you just mentioned of how do I know that what I'm building is going to be venture backable? Because that is what we do at the end of the day. There are companies that can become billion-dollar companies or at least $100 million company plus, so that the venture capitalists can get a return. But then I think even more interestingly, how do we use the AI and everything that's happening that can actually provide us with huge efficiencies, where maybe we can actually take a 1, 2, 3 person team and turn it into a 30-person team without having to hire the other 27 people. So there's like loads of things in there. Maybe if we start with the diligence, because I think that piece of it's like super interesting. When you look at diligence, when you think, okay, in where we are today, the world is shifting so quickly. Everything is gone. Like everything is now the speed of change. I think there's more unicorns than there's ever been. There's more unicorns coming from more places than there's ever been. The world is getting bigger, but feudalism is becoming stronger. Like it's this really weird place. And so we know there's 2 parties, right? There's one party, which are investors, and they are people who are looking to get the maximum return in the knowledge that valuations of unicorns and everything are increasing, and there's more unicorns in the world. And then you have founders who know that they're trying to build this perfect balance of, I want to build something that my customers love, but I want to also build something that investors will feel very greedy about. So when you like move into that diligence place, how would you speak to startups about what VCs are looking for and how it ties in to how they should go on their journey?
Yeah, no, that's a good question. So a couple of quick things and then more resources to dig into. So I would say the first one, as you know, it's always the team, right? Is this the right team to do this. And what I mean by that, I actually started this explanation most recently, but think about it, let's say you go to a meeting, you're showing up to a networking event, you're at a accelerator, whatever, there's 20 other people around, there's maybe 10 mentors. If you shuffle everyone's ideas around, sure, we can probably pitch your idea, but why can't they actually execute? And the answer to that is probably why you're the right team to do it. And if you can't answer it, then try to dig into, why you're actually solving the thing that you're doing, how you're adding that value. Because I feel like, and I don't know, correct me if I'm wrong, Brian, but a lot of the pitches that I see tend to be very generic, and I can't even put myself into the customer's shoes. So before we even get to the team, one is, all right, can I put myself in my customer's shoes? Can I envision what is their actual pain point? What is the solution? But then also how you're going to be solving it end to end, and how you're the right team to do it. I think that's the probably number one advice probably you hear from most VCs. I don't know, Brian, if you want to add anything before dig into other things.
It's super important. The thing about investing in 300 companies is you see so many patterns, and that's what happened. And I think at the beginning, my view at Expert Dojo was, the venture capital world is very unfair. I mean, there are people, maybe including myself, who would argue that it's very, sexist and racist and biased towards founders, and the same few people with the same few schools generally get a big ton of the money. And all of that is true. And at the beginning, I felt, well, we can change that because everybody can build a startup. And that's not true. And there are actually very few people who are true executors, real executors, people who are prepared to go through what it takes to go through, to sacrifice absolutely everything to make it from insignificance and poverty to riches, we'll call it. Even though most of us don't do it for riches, the end result is you get rich. It's just like, it's a byproduct. It's a symptom, right? And so going from insignificance, poverty, having nothing, teeny weeny idea, to absolute domination and a win, like you become the Microsoft out. There's just very few people who can do it. And so I ended up having to, and not only are there very few people, I'll even give you worse news. That's something that maybe you can lean into and change, is that even the great executors are not great executors for their entire life. There's a moment in time when those people, they hit their stride. They hit like a moment where you just see it. You see it in like how they are, how they show up on the day, what they do, what they're prepared to go through. Ego is gone, time is gone, tiredness is gone, worries about things, like it's all gone. Even a requirement to eat is gone. Like it's all gone. These people move into a zone which is just incredible to watch. And not everyone wins, but you know that their probability of winning is like so much higher. And what happens with investors is they get to see, especially people who've been investing for a while, you get to see it in their eyes. You see it in their speech. You see it you hear it in their tone. You see them at an event. There's like 200 people in a room, but there's only one of this person in the room. And they're not looking desperate, and they're not saying, oh, I need to pitch you this thing. They're not that person. They're the person that as an investor, you think to yourself, how do I get this person to let me put money in? They may even be pre-product, but you feel it. You feel it with the people there. And there's a couple of criteria behind it. Number one, like most of us, all of us end up changing our product from the beginning to the end. So we can't measure it just on the product, right? We can talk about the general sector that someone's going after and build probability in. And you can see it by the things people are doing, because what happens is they don't spend all of their time pitching. They are incredibly good at subliminally dropping reasons why they are winning. And they understand that actually working with venture capitalists it's a relationship. It's not a one-night stand. It's not that you're like, oh, choose me, choose me, choose me. No, it's like, let me get to know you. Let me share what I can do. So I think you're totally right. And the entrepreneurs that are in that moment of their peak physical execution of their lives, they know it and they feel it, and the people around them feel it too. And they normally fill their rounds through referrals, not even by going directly to people.
And maybe, happy to actually maybe give advice on, we talked about product changes and finding those customers. Maybe we can dig into that next after we talk diligence, because I do have specific advice there. But we talked about, the team. I think the next one, as you touched on, is venture scale. And I started using this example. So, why do VCs look for unicorns? And I actually have a blog post that's, why do you have to understand how funds work even as you start pitching? And the main idea is there's a whole, I'm sure you've covered the fund model, the 2 and 20 of, VCs make money on the 20% of the profits that they generate for their, limited partners who are high net worth individuals or other companies that are giving them money because they think that they can get better returns than other traditional investments like S&P 500, other things out there, real estate, whatever. And the 2% is the 2%.
Even though most VCs don't.
Don't return the profit. Yes, agreed. And then their day-to-day is covered by the 2% of the fund. So let's say if it's for simplicity, let's say 10%, $10 million fund, 2% a year is what, the day-to-day funds all the salaries and things like that. So let's say a VC fund invested $1 million for 10% of your company, and then has, re-upped it, then in your follow on, they've done, let's say, a few more million, then later a few more million, in their other funds. And let's say they're now up to, I should have said actually a bigger fund, but let's say they've invested 10 million for 10% of your company for the total. So if you exit for 100 million, which sounds like a ton of money, 10% is the 10 million they actually put in. So after all of the inflation and everything, they lost money. So the more that you can exit beyond that, the higher the multiple. And as you know, 90% of the startups fail. So if, again, or let's say it's actually $100 million fund, 90% of those fail, what they're looking for is which startup will actually return the whole fund. So that's why, to get 100 million or more, what do you need to exit at so that the 10% of that gets them back to 100 million plus? And the higher your exit, the higher the multiples, and then the better the fund looks. It's kind of, I have to mention that because I feel like a lot of startups forget, because again, 100 million is just so much money. So having that math in mind of when you're pitching of, okay, well, how are you going to get to that scale down the line? How are you going to, is it going to be with efficiency, as we talked about? Is it going to be technical scale? What does that efficiently look like? Does that include global expansion? Where is that efficiency coming from? And having that in mind from the very beginning, even if it's super fuzzy, but you can talk through, is really important. I don't know, Brad, if you want to add anything there.
Yeah, I mean, look, Kushi said it there. It's like, what's the primary problems of a VC a startup can solve? Just make the money. That's all a VC wants to do. Look, most VCs don't make money for their limited partners. That's the big problem. It's the thing that is not really discussed. And exactly to what Irina was just saying there is you have this environment whereby we have to get returns. Like if a VC doesn't get a return for their limited partners, there's not many jobs they can do. You're working in McDonald's or in Uber. You don't even get Uber because Waymo are going to take all the Uber jobs. So we can't even go to Uber anymore. So there's literally nothing we can do. And the ratio normally is 1 in 20 companies. So you're looking for one company to return the funds. And so if a company has, let's say a normal VC is like a $20-30 million that they have to do, and they're going to have 1 in 20 companies that's going to be able to break through. You have to be $1 billion company. So every VC is going to look at you as being needing to be at least a $500 million exit to $1 billion exit plus. That's when you can start to return the fund. And even that's with very, very minimal returns on the fund. So I think it's a super point. It's really, you want to make sure you can exude the confidence and also the proof that you're actually building that for the VCs.
And maybe we can dive in a little bit into, the product changes. And I will say I have a lot of different advice on my blog on what do I specifically look for in diligence. It's all free online for, from pitch deck to what are some questions I'm going to ask. And then I'm actually doing a workshop. It's for free with the M Accelerator on the 17th, where it's actually, I go through what do I look for when I do AI diligence. And the short answer is I kind of wear 4 different hats. I wear the VC hat is venture scalable. I wear the kind of the technical expert hat of, okay, if I were to develop this, what are some gaps, challenges I see down the line? Or even, are there data issues from the start? And those could be just super bright yellow flags to flag. And then kind of the product person of, will our customer even want this? And so I would say product and customer, right? Like, does this actually solve a customer need? And is this an actual product that's scalable?
And so when you stack rank these, where would you put on the top? So you're doing diligence. First of all, what are you looking at? You're looking at a data room. Do you care where that data room is? Do you care if it's in Dropbox? Do you care if it's on a drive? Do you care if it's on a in there and it's sitting on some obscure place? Should it be very big? Should it be very small? Like, talk to us about what you look at and where your bias goes to on the first level.
Sure. That's a good question. So I would say the diligence is almost 4 different tiers. One could be from the beginning of your pitch deck. One could be pitch diligence, where you're pitching to VCs or even VCs in a panel of experts, and I could be one of the experts or one of the VCs. The other one is the data room, and then the data room plus or also customer interviews. So kind of different levels. Honestly, data room, I don't really care where it is. Having been a technical person, everything's always a mess. But I think my advice to founders is, because everything's almost always a mess, I go in probably whatever order you put in there. So if there's a guiding, overarching document that says, hey, start here, this is here, here's the context, this is what we're doing, that makes it easier to follow along, then I'll open a thing and they go, this is interesting. What does this relate to? I have no idea. Then I open another thing and another, and then the feedback becomes, okay, then part of the perspective is, how much do you know about your company? Right? That becomes an interesting, how you organize things, how clear you are at some things. Again, it's just something that everyone will see when they look in the data room, but there's specific data rooms I've looked at that, again, it was actually only one that had a Google Doc with that context and made it so much easier to see. And there's been ones where, you look at the cap table and it's just like what is going on with this cap table? Again, if there's no context, if it's not clear, if it's too aggregated, so having the right and asking, right, too, of, okay, what information do they want? There are certain things that are standard or relatively standard, like the incorporating docs, the cap table, hiring practices, P&L sheets. Let's see what else. Anything that the VC asked for, I think that's another, I would say, yellowish flag, where you said, oh, we'll share that with you, and then you don't. Okay, why is that not shared? Why is it taking 3 or 4 weeks to get whatever you said you were going to share? So founders will say, oh, we'll share our technical architecture diagram of how things are going, but then actually didn't share that and shared something completely different. Then the question becomes, okay, it's, again, to Brian's earlier point, it's about mitigating risk. And so the more things that are fuzzy and unclear and contradictory, the more yellow flags there are. So that's kind of for the data room. I think we can dig into it. I would say 2 things that I watch out for. One, if you're in healthcare, I watch out for data leakage, and that is a big issue. So let me try to explain it, then we can talk through it. So data leakage happens when your algorithm looks amazing because it had information it shouldn't have had. And so if you take that information out, it is completely useless. So one example, which actually, well, there's many examples that made the news, but one example from 2017-ish was Epic had a real-time algorithm predicting sepsis. So these are infections at the bedside. And it is a big issue in many hospitals, and you actually see many startups even now trying to solve this. So they actually had an algorithm at the bedside that said, hey, if this is happening, somebody has sepsis, alert the physician. But what ended up happening was one of the variables in there was antibiotics, which, okay, great. By the time the physician ordered an antibiotic, they already suspected sepsis. So the algorithm said basically, okay, all of these variables plus antibiotic, great, we're predicting sepsis. Again, looked amazing. Physician already knew that. Completely useless. I see this a lot in anytime I'm pitched also a startup that's we're a diagnostic startup using medical images. Again, at the surface level, it sounds amazing, but what happens is, okay, in the way that the U.S. healthcare works, by the time somebody got a referral to an MRI or an echo, they already went through their primary doctor, they went through the specialty doctor, they got approved. So if my naive, silly, stupid model says everyone got that condition, I will do just about as well as whatever fancy algorithm they used, just because of the nature of the data. And so anytime, not just healthcare, but there's been other things, that's the first thing I watch, and that becomes something I flag right away of just, hey, no matter what we do, there's an issue here. Can they correct it? And can they correct it? And is there still a product? That's usually, I think, the biggest red flag. The second one is, I would say, and Brian, we've had offline discussions about these, is, I actually tend to be biased against agentic agentic apps, which are popping up everywhere. And we can dig into why. And there's certain, I would say, especially in regulated industries. So my thing is, and by regulated industry, I mean like fintech, legal tech, where, the risk of getting the prediction wrong is much, much higher than if I used an LLM to draft an email. So if you think that there's no risk of getting the answer wrong, go ahead, please. I am not worried about you. But if you're trying to predict, let's say, how do I submit my taxes? And I'm half making these up. How do I, taxes, or again, legal tech, huge thing, contracts, those things, having one thing wrong could lead to a lawsuit, and your brand could just be tanked overnight. Again, like, I don't want to just be the carrier of bad news, but I think that is the question to ask yourself. We can talk also about like why and all of those things. The other thing I worry about when I do diligence, and I hear this all the time, is, well, we just have an LLM write code. Like, I've literally tried having an LLM give me baseline code, and I end up debugging it and then just scrapping it and starting from scratch, just coding my own, because it's much it's much easier to write your own code than debug someone else's. Let's be honest there. But there's ways to do mock-ups, and there's certain things that it could still do, but to have it be the primary source. And then when you're an agentic startup, a lot of the startups, when we talk about actually milestones, we forgot to talk about that, of what are we diligencing. I always look at what are your milestones to your next goal, or how are you gonna your next scale in your startup. I think a few years ago, part of that goal was, okay, we're just going to spend it on Facebook marketing, whatever. Then 2 years ago, it's, okay, we're going to spend it on engineers. Now it's, okay, we're going to spend it on researchers that are going to develop these models for us. Well, that's like funding somebody's PhD, which, as somebody who got a PhD and had to fund my own education, like, that would be awesome. But as somebody who's been in industry, there's no guarantees. They're not going to write production code. It's not going to be scalable. And I say this again as a sample size one of who I was originally an academic who wrote really shitty code and learned things the hard way of, how do you get code to run internationally in 60 countries that you're maintaining and will break at 3 a.m. and get a call, you got to solve it, right? Like, it's mission critical. And a lot of the startups, I worry, that for their, and again, maybe now is probably the time to figure out, like, to give that advice of how to find those customers rather than I'm going to market with an LLM as the product that will do everything. I'll stop here and I'll say, Brian, I
It's a
don't.
little it's a little bit like super fascinating because and this is a so you bring up, if I just go through the sequence of points that you made within the data room, just be very transparent, like balance the transparency with the completeness of what you actually have in there with the promotional aspects of what you want people to see. Like there's a very, very important balance of those three things. I'm a huge fan of people putting their bank statements inside the data room. Like, why would you not? What are you trying to hide? You should put it in there. Like, there's nothing proprietary in your bank statements. The only thing it's going to tell is if you bought a watch or if maybe you're going to like Cancun every like 4 weeks. But if the other stuff is, hey man, I'm just trying to survive. And I got a couple of months left in here, but as you can see from this, I make it work. Like it's okay. You should show that, like show everything. Again, I keep going back to the relationship thing. The more that you share the nasties along with the lovelies, the better the relationship's going to be in the future, just like period. And most investors are 100% sure, for a very good reason, that the startup is lying to them, right? And the thing is, like, you don't wake up in the morning wanting to lie to the investor. Before you lie to the investor, you lie to yourself, right? So it's like, hey, we're gonna like have it straight up here. This is growth. It's like sorry, year one, $100. Year two, 17,650,000. Like it's just so silly. It's so silly. So first of all, like exactly what Irina's saying. So like, be super transparent about what you have. Make sure there's a logical format of what you've got inside the data room, and make sure it's complete. And if you're very early stage, your complete is going to be very different than if you're a Series B or a Series C company. So you have it there. But what you're trying to show people is, look, you can trust me. I'm not guaranteeing you this thing is going to win, but I've chosen a very big market that allows this company to do 10, $15 million a month in revenue. I have approached it in a way which is highly unique, whereby I'm going to do it. And I'm going to be very transparent with you about all of the things that we've learned and why you should then rely on the areas that we're very strong on. And you balance those three things, people will love it. Remember, this is your story, your script. You get to write it, but don't be slapdash about it. Don't just put a couple of things in there and say, yeah, it'll be fine. They'll just look through it. This market is very different to 2021. In 2021, I don't think more than 10 or 20% of VCs even looked in data rooms. Everybody looks in a data room today. You've got no choice. The second thing, which I think is so important about what you said, this is like in the 1970s where people are like, yeah, it's like, we're going to do the internet. It's going to be so cool. We're just going to like blow up. It's like, no, there's 4 people there at the moment. There's going to be people there in the future, but then there's going to be so many people in the future. And so there's no people to so many people. And so where do you fit into that like craziness that's going to be in the middle? And how do you know, like, what have you got that's special that's putting you there? And I agree with you. Everybody's now talking about AI, 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 AI. And half of what we see are just people building on the back of OpenAI, which is totally fine. But that's not your uniqueness. And so you have to show, why is it that you got this thing that is so special in the world? And even then, people are probably not going to believe you, which is totally fine, because what you're going to do is you're going to build this beautiful subliminal marketing engine that just drops, 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 drops until a moment where, like, investor, team member, partner, OEM, anyone else who's in your sphere of influence that you want to be involved in you, those people are like, man or woman, I've been watching you for a while. You are crushing it. I was like, yeah, we are.
Yeah.
Because you,
And maybe, no, so yeah, sorry to interrupt. Maybe we can talk about, my number one advice that I think, how do you actually find who's actually using your product and how to niche down? And I would say, I think most startups forget is they don't track interactions of what's going on with how the customers are actually using their product. Right? They get the transactions, they get the, it's the funnel from, okay, you went to the website, Who downloaded it? Great. Can you track that? From downloading to activation, can you track that? Okay. From activation to login, who's able to log in? Who forgot? Who is getting stuff reset? What does that all look like? Great. They logged in. Who did what? What is their first experience? And then you hear this term, aha. So if you're doing, let's say, you're doing an efficiency, you have a supply and demand. Maybe your aha moment is to the match. How long does it take to get the supply to match to meet demand? Whether that's mentoring, tutoring, selling, CPG, whatever. What is that time frame? And can you track that? Because actually most probably don't. Okay, maybe you are able to. And if not, then that tells you, okay, you have to go back to your app, your tech team, your consultant, make sure that's in there. Great. Okay, now you finally have it in there. Is that, let's say, 3 weeks? They got to that. Okay, how do you make it 2? How do you make it 1? Who is the super user? How do you even define a super user? Do they have to log in and buy something within a month? What are those actions they got that to the first purchase, from your marketing channel to what are the steps that they saw? What are the things that, how are they interacting? Were they, we can take any one example and walk through these things, but how does that, being able to track those things, and also being able to see drop-offs of, okay, they did great, and then all of a sudden it was silent. None of these people logged in. What happened? Did the product suck? Or there's an outage? Or something else is happening? And being able to see that and monitor that is going to be leaps and bounds. It sounds like so easy, but so I would say over 90% of companies I talk to are shocked. I'm shocked they don't do this.
I actually want to just draw a line underneath what you're talking about here, because it's so important. Actually, it's the most important thing that there is. Like, we all know, look, to the question here from Ashish, it's like, what are the fundamental factors VCs are looking in startup? It's a very simple algorithm, right? A company gets to like 20, 30K a month, they fumble their way there, and then you grow it between 100 and 200% every year for like 5, 6, 7, 8 years, and you're a unicorn, right? Like 30K a month to like 90K a month, 90K to maybe 180 to maybe like 360 or 540 to $1 million a month. Well, yeah, you're at $1 million a month now. Like, that's all they want to do. But the only way that you can grow at that 100 to 200% every single year is through understanding your customer, right? That's the only way. And it's totally true. It's just such, like, everything you've just said there, there's no way I can say it more eloquently. It's all about the customer. And the more that you show that you are desperately trying to understand every stage of that customer in the pursuit of that 100 to 200% growth, you just can't, it's just impossible to lose. That's all there is, right?
Yeah.
So, like, it's the customers. It's like nothing else. And by doing that, by getting super obsessive with your customer, like, even to the extent of, like, I'm sorry, VC, I just don't have time to talk to you. I'm so focused on my customer. I'm in one of their homes right now, uninvited.
I love that.
Like, it's going to be a stalker.
And I will say I have a couple of resources also on my blog about it. You keep hearing the product-led growth, and there's a framework. Phil Libin of Evernote gave a talk, I want to say a few years ago, that said every company can be summarized by 14 different types of customer flows. And I actually walk you through, I borrow that, and also walk you through to say, again, supply will have its own 14, again, from first-time users, retained, who's churned, activated, all of those things. And that's available also for free. The talk, the slides. And I'm also giving a talk on this next week with Grid 110 on product-led growth step by step. But the main idea, again, is as soon as you start tracking things, because where I do see a lot of startups, understandably, there's a lot of shiny things out there. And so, okay, should we try this feature? Do we need to build this feature? Or let's say, actually, they will come to me and say, okay, let's help us build this super cool AI feature. And I go, okay, great. Well, how many customers are using the feature that is currently in there that the new one will depend on? And they go back and, oh, most people don't use this. Okay, great. Well, now you don't have to build that. You just saved your runway. Let's focus on what is actually happening. And then what you'll probably see is you think you have one set of customers, but after you track these interactions, you'll probably see actually the customers are using things completely differently. And when you focus on those and understand those better, and you'll find those like them, that helps you expand your customer base. So the main idea is, again, you're trying to find your super users that are also generating the revenue or most profitable, figuring out how they got there and what are the things that set them apart. Because at the end of the day, you want to figure out how is somebody on the path to be a super user and give them enough nudges to convert to be that super user. And then once they convert, again, it's how do you nourish them and all of that. And it sounds, again, not, it sounds almost like too simple, and very not sexy, but honestly is very practical.
Yeah.
And the way that, we touched on AI just a little bit, but I would say to start, make it super simple in terms of, okay, if you do X or just like one thing, two things, three things, then you can tell who's the super user. That could be an if else statement. Like this is not fancy. It could just be in your app. The algorithm could just be, if they see this, great, we're going to send them this message, or they're going to see this pop up or whatever to try to get them to the next step in the journey. Then if you see things are repeatable, you can have a slightly fancier algorithm, not much fancier. But again, it's about making the right trade-off between how are you going to debug something at 3 a.m. and how do you get all of your stakeholders on the same page? Because it's much easier to explain the logic, again, everyone understands it, than to say, oh, we're just going to send it off to OpenAI and we're not sure what we're going to get back from it.
It's true. And what I really like here is, and by the way, I'll answer this question to Divya real fast. We'll do 100K checks in India, and then we'll do $1 million follow-on checks for the companies that we bring through. But I want to just get back to this other point about like the factors. It's that, think of it like exactly as you've just said it there. It's really funny. We could do this for like 3 hours, because we go down like such a cool rabbit hole on product-led growth, and we could go down such a cool rabbit hole on, with agentic and with everything that's happening in OpenAI. Is it hurting us as founders, or is it actually helping us as founders? Like, is it making just much more sameness out there, or is it actually allowing us to really lean into where we are, and how much of what we have to do to be innovative, to build the next Slack, the next WhatsApp, the next Facebook, the next Uber, the next Waymo, right? How much of that is actually now being generalized, where the same advice kind of, and the same like innovation kind of, is now going to go to like 500 million people. Everybody's just going to get the same stuff back. But I think especially in the last couple of minutes, you brought up like such a huge point on really loving your customer, but at the same time, it's like there's almost like three parallels that you're suggesting people play in. You're saying, number one, like your product growth and your obsessiveness about your customer is the key to everything. And if you don't have that, you honestly don't have anything. Like if you're not showing up for your customer like 50, 60, 70% of your day, nothing else really matters. And then you have to be aware that at some stage you're going to need fuel on your fire. Like, it's not necessarily at the beginning. At the beginning, maybe you get 100K here or 200K there or whatever, right? But it's all about your customer. But then you need fuel on your fire, and you need to manage those relationships in a very grown-up way. You can't manage them like it was 2020, 2021, where just there's money flying everywhere. You have to manage them in a very grown way. And that means that you need to have proper data rooms. You need to have proper cadence with regards to communication with your investors. You have to be very transparent with them. You cannot lie about things that are happening, even if you don't know it's a lie when you're telling us. Well, who I'm talking to, most people, right? And then at the same time, it's like, how do you incorporate what is happening that's providing efficiencies in the world through AI and everything's around it, so that you can like bridge that gap between 10 years ago needing 50 people and today you can be like a 5-person unicorn? Like, it's those. Have I summarized what you're talking about? Okay. Or like, how would you, in the last like 2 or 3 minutes, maybe give the best advice for all the folks listening here about either A, if there are pieces that I've left out, which I'm trying to just say what you said, but B, like they're approaching 2025. How do they smash it out of the park?
Yeah. No, that's a good question. Yeah, I think you've summarized it pretty well. I would say maybe going back to how we did the opening sequence. So again, I don't know if founders know that each VC, no matter, I would say even for an average fund, sees thousands of pitch decks a year. Thousands. And they probably give a check to one or two. So to stand out, and again, it's much easier to give this advice, the more you can talk about, honestly, I think we're a few quarters away from profitability. And maybe that's the opening line of your pitch deck. Gets everyone excited and sees that you're different than everyone else. And the way to do that is kind of how what we talked about today, we only just touched a little bit, is how to go step by step to figuring out who is that customer that will get you to that profitability and how to get more like them. And again, it sounds maybe too simple, but honestly, the more you can tell that story, the more you'll stand out from everyone else.
Yeah. I love that. And how do you feel AI is going to intersect going forward faster and faster and faster with
Yeah.
all of these vendors? By the way, I love that comment about like, accentuate the good stuff. Like I talk about transparency and honesty and everything else because we're in that market of fear right now. So you need to be almost saying, look, I'm telling you so many bad things that you would not want a relationship with me, but actually I'm so cool in the way that I say it that you found the really good things that makes you really want to have a relationship with me. So I really like that. And I really like how you accentuate at the very beginning and say, look, we've grown at like 400% every year for the last 4 years. Like that's slide 2. And it just has got a big 400 and a big percentage mark. And like every year underlined in bold, right? And so that's what you're saying. But then all the way throughout the deck, you're giving all of these other areas where you're showing it. And so how do you feel if somebody's thinking to themselves, okay, I get this. I get the focus on the customer. I get the being transparent. I get like accentuating at the beginning. So I'm like balancing that transparency that I'm giving with the investors. But what should I be preparing for from an AI perspective and integrating that into my startup?
Yeah, that's a good question. I would say, I mean, the lowest hanging fruit would be efficiencies, right? It's figuring out, I would almost say, the way that I think of AI is it's about finding a repeatable pattern and then helping you semi-automated with AI. What I mean by that is you try to, I would almost say, suggest. So if you have, again, especially if you're in the regulated industries, human in the loop to check or sign off on your replies. And then again, that gives you feedback in how people are engaging, just and then you'll see, oh, from this context, most all of my replies got accepted. Great, that becomes automated. Next low hanging fruit. How do we semi automate suggest things? And maybe what you end up doing, actually, this could be a whole other. I think where a lot of startups struggle is I feel like they always have to make a recommendation. But, I would say if you've ever interacted with Amazon chat, it's structured feedback that says, do you want a customer service representative? So there's only certain things that you can automate and then you can get help. And again, having that tiered of, okay, the things that are super easy to predict or relatively easy are those patterns, great. You can automate them. And then next level. So it's the start with whatever is easier to, and actually I also have a blog post that says how to build confidence with AI, or how do I get my customers to trust? And again, it's the lowest hanging, whatever super obvious you can predict, great. Then go the next obvious. So you're always, again, trade off between how much it takes to develop and maintain and how much value it's bringing to the company at the end of the day. And that might
I
be a
love
separate topic.
think it's such a great call. It's like every single thing that you do today, everybody watch it, notate it, see which ones of them can be automated, can build efficiencies into, question every single task. I love that. I could be on with you for hours and hours and hours.
Sounds like it
As
might be part
always,
2 next quarter. No.
yeah, as always, we should do a training, actually, honestly. That's what
That
we're
sounds
going to
good.
dig into next. But look, you're the best in the world. Kishle, can you please put Irina's email, our contact details in there as well, so we have it? And then any other blogs as well. Yeah, you're awesome. That was amazing. And you and I will continue this. Everybody, you heard it here. You know what to go after. You know what investors are looking for. You know how to build a unicorn. Honestly, we're in a time of chaos. This is the best time to build a unicorn. You know, the definition of chaos is between two states, right? And we're between two states right now. So, like, use that. This is your time. Don't you be complaining about, oh, tariffs are affecting me. No, tariffs are killing your bigger competitors who actually make money and live in big houses. Use that chaos so that that next state becomes your next state. That's it. That's all I got for you. Okay. Irina, you're awesome. We'll keep going. Thank you, everybody. Thank you, Irina.